Hello, and thank you for joining us for the second quarter market update. My name is Jason Gunkel, and I lead our investment team here at Severson Strege. The second quarter was much better than the first, as the stock market rebounded and recovered its losses on the year. Stock returns for the year are now positive, with the S&P 500 up about 3%. International stocks are still leading the way, with the MSCI EAFE stock index up over 15% year to date. Bonds have maintained their stability for the most part amid the stock market volatility, with the Barclays Aggregate Bond Index up about 3% year to date. Please note we are recording this about a week prior to the end of the quarter, so these numbers could change. U.S. trade policy dominated the market news again this quarter. The stock market started its rebound on April 9th when the president announced a 90-day pause on the so-called reciprocal tariffs for most countries. On May 12th, the U.S. and China reached a trade agreement that included a 90-day pause on tariff escalations and significant reductions on tariffs between the two countries. Then on May 23rd, the administration said that it was considering an assessment of a 50% tariff on all imported goods from the European Union beginning on June 1st, which was later delayed to July 9th. So these extensions on trade negotiations will start to expire in the beginning of the third quarter and will be a focus of the markets once again. They have the potential to cause additional market volatility, but we are cautiously optimistic that the agreements will eventually be reached and tariff levels will end up being much lower than initially announced. When the broad sweeping tariffs were suspended on April 9th, the stock market jumped nearly 10% in one day, which was the third largest percentage gain in a single day since World War II. It demonstrated the importance of staying invested during market downturns. While investors can be tempted to take their money out of the stock market while it is dropping, they then must decide when to put their money back in. Market recoveries often happen quickly, and missing even just a few days of positive returns can have a significant impact on a portfolio's long-term performance. International stocks are outperforming U.S. stocks this year after several years of underperformance. There has been a surge into international stock funds this year, according to Morningstar, driven by factors such as strong company earnings, concerns about U.S. trade policy, a weakening U.S. dollar, and international stocks looking cheaper from a valuation perspective. This has helped remind investors that having a diversified portfolio is important during times of market volatility. Bond yields generally dropped in the second quarter, which caused most bond returns to be positive. Interest rates in the 1 to 7 year range dropped, with investors seemingly more worried about economic downturn rather than higher inflation. However, longer-term rates beyond 7 years started to turn higher as investors seemed more concerned about rising inflation and U.S. debt levels in the long run. Mortgage rates have stayed near 7% for the quarter and remain stubbornly high. The proposed new tax bill is working its way through Congress, but seems to be inching closer to passing. The good news is that it would cut taxes, but it is still projected to add trillions to the federal deficit, according to the Congressional Budget Office. This could raise longer-term interest rates further. The Federal Reserve held interest rates steady throughout the quarter, marking the fourth consecutive meeting where rates have been left unchanged. The Fed is still taking a wait-and-see approach as they weigh economic policy effects on inflation and growth. So far, inflation continues to remain in check, with the Consumer Price Index rising only 2.4% year over year in May. But economists are concerned that U.S. tariff policies could cause an acceleration of inflation in the coming months. The European Central Bank, however, has cut interest rates in the second quarter, and that is another reason that European stocks have performed better. Investors will soon be paying close attention to second quarter earnings results. Heading into the year, earnings for companies in the S&P 500 were expected to grow close to 15%. These expectations have since dropped to 9% as companies are taking a more conservative approach to their forecasts, due mostly to the uncertainty created around their costs affected by trade policy. From a valuation perspective, the price-to-earnings ratio of the U.S. stock market still looks above average, so it is important that companies come close to meeting their earnings expectations. As the quarter was wrapping up, the U.S. attack on Iran was causing some increased market volatility. However, there was optimism that the conflict was de-escalating, and the markets rallied on a potential Israel and Iran ceasefire. This adds to the geopolitical uncertainty around the world that investors will continue to watch closely. Given all of the geopolitical and economic uncertainty, we do not think this is a time to take on significant risks. We are tilting towards higher quality and lower price stocks, and also focusing on higher quality, shorter term bonds. With international stocks and bonds adding stability to portfolios this year, it is a good reminder to stay diversified. We also want to make sure that our clients have enough cash set aside for their upcoming expenses. Thank you for your continued trust in us, and we will continue to monitor the markets so you don't have to. Take care, and we look forward to talking with you soon.